Welcome everyone to the September 2025 edition of NDSU Extension Agribusiness's Agricultural Market Situation Outlook webinar. My name is Dave Ripplinger, Extension Economist and moderator, IT troubleshooter, whatever it might take to get things done. We're going to follow our standard format. We're going to have presentations from Brian Parman, Frayne Olson, Tim Petry, and myself discussing a variety of very timely issues related to agriculture and the broader economy. You're very welcome to ask questions. We'll cover those at the end. You can submit those either with the Q&A tool or with the chat. Then, as I mentioned, we'll get to those at the end of the presentation. Feel free, again, to ask any questions. And with that, I'll just go ahead and turn it over to Brian.
USDA puts out a semi-annual, one in September and one in February, income and expenses forecast every single year, and it's it's a projection of where it's not the current year is a projection because obviously we don't for sure know how incomes are going to look from 2025. That will be basically solidified next spring. But then it also does have the actual figures going back, as many as 20 years. And I'm going to show you the charts from the report and comment on it. But I do want to put on the title slide here, if you want to read the whole report that they put out, I went ahead and put the website right here where you can find it. But you could also just, Google search USDA net farm incomes, and this report will be the first one that should be the first one that pops up. So this is that forecast I was speaking of, and what you see is they're expecting net farm income and net cash income to be significantly higher for 2025 relative to 2024. In fact, net farm income up right around 28.5%, and you can see where we were, last year. And what's one of the things that's interesting about the situation that we're in right now is if you look at 2024, for instance, net farm income right here, the blue line, and where 2024 was, it was pretty much average. Actually, so this blue horizontal line here is the average net farm income from 2005 to 2024. And this is, by the way, adjusted for inflation. This is in 2025 dollars. And it was above average. And yet we don't think of 2024 being a particularly strong year at all. And net cash farm income for 2024 was also right around average. And like I said before, we don't think of that as a very strong year at all. And then you look at 2025, and this is what net farm income is expected to be, and right around 180.7 billion, comfortably, or 179.8 on net farm, which is comfortably above average. In fact, it's not as good as 2022, which was a record year, but it is getting close to that on aggregate. Okay, so and a lot of what we've been hearing, right, is how desperate times are for a lot of our producers. And yet if you looked at this number just on its surface, you would say, well, how can that actually be? And we'll talk about it here in a second. And one of the things you see is basically across the board for crops that we raise in North Dakota, declines in cash receipts for these. So you see corn declining from right around $63 billion down to 61 for cash receipts. Soybeans down almost $3 billion as well. Wheat down just over $1 billion in cash receipts there. So some significant reductions in income for a lot of our row crops. Then you look on the cost side and we see, well, labor costs have gone up. Of course, livestock purchases will go up because prices have been so strong. Interest rates increasing for 2025. Rental costs going up, taxes going up. And then all the rest of these, for the most part, have been hold evens, with the exception of feed costs, but that's because commodity prices were so low. And so we basically see 2024 an increase in costs, and then a decrease in most of our major row crop cash receipts for this last year, for the year that we're currently in. And if you look overall on inflation-adjusted production expenses, they're pretty close to where they were last year, maybe just a bit higher. Okay, so what do we see? We've got low cash prices for our row crop production, and for the most part, production expenses are slight, if not even just slightly higher than they were a year ago. And again, all these charts are adjusted for inflation. So where are we seeing this big increase in net farm income? All right, because net farm, that includes, by the way, crop and livestock production. That's the whole system. And cattle and calves 2025 are having pretty expected to have a pretty strong year. You can see the difference here of right around, $17 billion increase in cash receipts for cattle and calves. And as Tim will talk about, that's not because there's a whole lot more cattle all being sold. The price that's being received for most of these cattle is just extraordinarily high. Dairy about the same. Broilers up significantly. Hog prices, cash receipts for hogs up significantly, and then almost a $7.5 billion increase in cash receipts for eggs. So you add all these up, that's increasing that net farm income number as well. Okay. And if you look at this chart here, if you look at all commodities, it's actually an increase from 24 to 25 expected, and the big driver of that's being animals and animal products. On the other side, we're seeing a reduction in cash receipts even from 2024 on the crop side. But that doesn't explain all of it, okay? The last portion of that is direct government payments to producers. And if you look here at 2025, and you've got that large gray category, which USDA is calling all other payments. That was the bulk of this is the program that was passed back in December of last year and then paid out through 2025. That's this big gray bar. Because if you look, payments as a function of commodity prices, that's this little tiny olive colored sliver right here in the chart of 2025. And then conservation payments, WRP, CRP, that's the lighter colored green portion. All this gray is that policy that was passed before. So then what kind of situation are we in, or what are we looking at? And I just want to turn your attention to this. And I've talked about this in other presentations, and I wrote about this in our newsletter. But what's happening to our rates of return on equity and assets? And the trend has been down, since for the last 25 years. You look at these years and you say, well, where net farm income was, if we go back and look at 2007, so I'm going to back this up if you just bear with me real quick. 2007, that'd be about right here. This is where net farm income was adjusted for inflation, actually below average. And you look at where net farm incomes were and net cash incomes in 2013, 2012, 2014. 2022 was a record, right? By far, even adjusting for inflation, and you can see that there. But then we come to this, to this part of it, and you see how high rates of returns on equity and assets were in 2011, for instance, and how high they were in 2007, despite the fact that 2022 had a much higher net farm income than either of any time during this period, and yet our rates of returns are so much lower. And why is that? Well, the value of our assets are so high despite the fact that we're not generating as much income as we used to out of it, not relative. In other words, the asset turnover rates in farming have been trending downwards now for 25 years. And it's because those high costs of farmland, equipment, things like that. Now, last thing I'm going to talk about just real quick is the Fed met this week and the board voted to reduce interest rates by 25 basis points, or the federal funds rate by 25 basis points. And I know that's been in the news, and it's a big deal from a standpoint of where mortgage rates and interest rates will be in the future, as well as on the investment side, bond yields and everything else. You probably noticed that there wasn't a huge change despite the fact that that took place. That's because, for the most part, the markets have been expecting the Fed was going to cut rates at this meeting for a while now, and probably by about 25 basis points or 0.25%, which they did. But I do want to remember, and something I reiterate when I'm discussing this, is that the federal funds rate is not the only thing that impacts interest rates. It is a factor, but there are many other things like demand for treasuries by the public, how much of that's being bought up, demand for buying mortgage-backed securities. Then you got the Fed's actual balance sheet, which has a big impact on interest rates. How much assets do they actually hold, or how fast do they roll off those assets as they expire and things like that? That remains to be seen. For instance, one of the things that could happen is, let's say interest rates drop far enough that a bunch of people who have higher mortgage rates decide to refinance their house or whatever, some purchase that's very large. They do that, and then the Fed decides, well, we're not going to repurchase those mortgages because once the mortgage basically is refinanced, the balance is paid off, and then a new mortgage is taken out at a lower rate. Well, the Fed could just say, and they have in some cases, yeah, we're not buying up those mortgage-backed securities. The private sector is going to have to invest in those. That could actually cause rates to go up to get all those sold from all the people refinancing, right? Because the Fed holds a lot of them. So I just want to caution you on what's going to happen with rates in the next 4 months or however many months, even if the Fed does drop the federal funds rate, because there are other factors that move into this, and not only that, but expectations as well. So with that, I believe Dr. Olson is our next speaker. So I will go ahead and mute myself, and I will be on at the end of this to go ahead and answer any questions. So thank you.
So, hi, I'm Frayne Olson, crop economist, marketing specialist with NDSU Extension. I'm going to be talking a little bit about the USDA September WASDE report, as well as provide an update on some of the trade issues. So let's dig right in because we got a lot to cover. So USDA, they update every month the WASDE, which is the World Agricultural Supply Demand Estimates, as well as the production report or their estimates of production. So a couple things as far as data sources. The September production report is they re-survey farmers and what their expectations are. USDA also does uses some the satellite imagery or remote sensing to try and update yield forecasts. But they in September and October they also send out individuals to go into the field and actually do what they call objective yield surveys. So they actually send people out doing yield counts, very similar to what a crop insurance agent would do. So we're adding a third data point now, or at least a third source of data, if you will, for both corn and soybeans. So we're starting to zero in a little bit more on what the yield and yield expectations are. So there were some updates, which I'll talk about in a little bit. Really, the change in the corn and soybeans were about expected. There really wasn't a lot of shock value to this report. It was slightly negative for wheat, primarily because the global ending stocks increased. So it was more on the global stage than it was necessarily with U.S. wheat and wheat supplies. New crop export sales are driving local basis levels, and I'm going to talk about that a little bit. Been a lot of discussion since our last chance to visit online about this, and in particular soybean and soybean basis levels and what elevators might be doing during harvest. And I'll try and address some of those questions and concerns. The other piece is, obviously U.S. trade relations with China. Those negotiations are being watched very, very closely. I'll give you an update on what we know regarding that. So let's look at the production report first. I just wanted to give a reference point. As usual, the blue line on top, the blue row on top is what the average trade estimate is. This is what the traders and analysts were expecting to see in the report. If you drop down towards the bottom, the highlighted black line is the report, the values from last month's report. And of course, the bottom line in red is the report values that we got last Friday. So what I usually tell people, I just want to remind one more time, is what we're really concerned is not necessarily about the change from the black line down to the red line, but it's from the blue line down to the red line. So what were traders expecting to see versus the information that we actually got. Starting with corn first, the trade was actually expecting production numbers to decrease, and they didn't. They actually went up, which you'd say, well, that should be negative to prices. But there was an offset in just a moment here that I'll talk about. So the traders and analysts were expecting a reduction in the forecast for the national average yield, and we got that. Last month it was the surprise of 188.8. This month we came up with 186.7. So there was a reduction, about a 2 bushel per acre reduction in our expected yield. And it wasn't quite as big a reduction as what the average trade guess, but it was very, very close. So how come did the total production numbers go up? If we drop the yield, why did it go up? The short answer is we USDA updated the planted and harvested acreage number. So we added some more acres to our formulas. So over the last couple months, we started with the acreage report based off of the June survey of farmers. Beginning in August, USDA starts to add in or adjust planted acreage for the reporting into FSA because of the farm program registration. And we're seeing that based on certifying acres with FSA, we picked up some corn acres, some expected corn plantings in the August report. We picked up some additional acres in the September report. So there was a reduction in the yield. There was an increase in planted and harvested acres. So planted acres, they adjust for expectation for corn silage. And now all of a sudden we have a bigger crop in the September report than we had in August. And again, the market was expecting the production numbers to go down. Shifting over to the line for soybeans, again, the trade was expecting a slight reduction in the yield forecasts. And we got a little bit of a reduction, but I would call that a change in rounding error. So the acreage numbers the yield numbers for soybeans were basically unchanged. But just like in the corn case, the acreage numbers went up. So again, based on FSA certifications, the soybean plantings went up just a little bit, and that was enough to offset for some of the slight drop that we saw in the national average yield forecast. So from a total bushel produced standpoint in soybeans, we came out with the trade was expecting a slight decrease. Again, we got a slight increase. These are not like titanic shifts, but they were enough to say, well, what the heck is going on here? So now let's get to ending stocks. And there were some adjustments. So this is old crop. We're at the end of the old crop year now. And in September, actually on September 30th, we'll get the quarterly stocks report. Okay, and that will be the survey that USDA does to say how much grain is inventory just before harvest. So it'll be released at the end of September. The survey was taken at the beginning of September. So those numbers in that survey will become the official ending stocks for corn and soybeans. So this will probably be one of the last times I talk about ending stocks for old crop. How much of old crop corn and soybeans are we bringing forward into the new crop year? Again, they weren't really big adjustments. The production numbers have basically been locked in. The change in corn, the slight increase in corn, was primarily due, let me look at my notes, to a slight reduction in the amount of ethanol. So the amount of corn going to the ethanol sector for last year was brought down just a little bit, which meant that our ending stocks went up. The soybean number really didn't change. So let's move into the ending stocks for new crop. So this would be the numbers that I just showed you on the production side. Let's see how much of that ended up in the bottom line for our forecast or projections for ending stocks. How much are we going to have left in the bin this time next year? Now, for wheat, the ending stocks numbers did go down. The trade was expecting basically neutral numbers. They went down a bit, mainly because USDA increased their forecast for exports. So the total wheat exports in the new crop marketing year are expected to be a little higher than what they had before. They adjusted that one upwards. For corn, again, we brought in a little bit more corn from last year. We see higher total yield numbers, but our ending stocks actually went down a little bit from last month, which was a little bit of a surprise. The primary reason is because USDA increased their forecast for total corn exports by 100 million bushels. And that's a pretty substantial change for 1 month. But that increase in export demand, or what they think will be turned into export demand, basically offset all of the additional bushels that we're bringing into the year. So the bottom line, how much corn do we have within the supply chain, or excuse me, within inventory or storage this time next year is basically unchanged from last month. That's why we really didn't get a big price response. Similar story for soybeans. The trade, we did get a little bit of a bump up in the total ending stocks, but again we saw total production increase a little bit. They made a few adjustments internally on the soybeans. They increased the crushing number and they decreased the export number. They increased crush by about 15 million bushels and they decreased exports by about 20. So the moral of the story is there was some offsets. So even though it looks like we're going to produce a little bit more, there are some adjustments on the usage or consumption side. And our bottom line really didn't change a lot. Again, thus the reason we didn't see a big price response. So let's talk in more detail about exports. And I've showed you this kind of table in the past. I updated it based on the export information we got, export sales data we got this morning. So let me explain it very quickly. The 4 columns on the left-hand side. So these columns, if you can see my cursor, these columns over here on the left-hand side are 12-month totals. How much corn did we sell all of last year by country? So this column marked 24-25 is last year's crop, that's old crop. How much corn did we sell by country? Now, I just want to comment that if this number holds, when we get the official final closeouts, if this number holds, that will be a new corn export pace. That will be the highest level of corn exports we've ever had in the U.S., period. Okay, so last year was a very, very good corn year for corn exports, actually larger than what we saw during the Phase 1 agreement. And if the countries here are ranked based off of this column, so last year's sales numbers. Now, these 2 columns on the far right-hand side, which are the ones that I really want to focus on, are year-to-date sales. So the column on the far right-hand side is the updated numbers we got this morning. So how much corn have we sold, usually under contract, for delivery in this new crop marketing year? And some of those sales were made several months ago, but they're recorded as deliveries in this new crop year. So these are contracts that have been signed for the delivery of grain in the current marketing year. And if we look at the bottom line number, the column right next to it is the same time period last year. So this column marked 2024, last year total is 69 million metric ton. Last year at this time, we had pre-sold essentially 14 million metric ton. Well, as of the report this morning, it was 23.8. So we've had about a 67% increase in the amount of corn that has been pre-sold for the current marketing year. So right now, it looks like our corn export sales are well ahead of the pace that we had last year. Now, whether the total ends up to be larger or not, we'll have to wait to see. But so far, we're off to a very, very good and aggressive start in selling our corn crop. And we're going to need that if we're going to get rid of all these bushels we're going to be harvesting here now in a few weeks. Okay, so that's a good thing. And the reason I'm going through this is this has impact on local basis levels and what the market is signaling for storing or shipping grain. Next, this is the same number for soybeans. Same basic layout in the table. We're looking at the soybean numbers. The bottom line number, if you notice, has been bouncing around a little bit. This is not going to be a great export season. It's better than last year. Better than 2023, but the 2024-25 is still not really great based on history. Now, if we look at where we are today versus the same time last year, we're at about a 35% discount. So we've sold about 35% less this year than last year. And if we look at the countries, this is the top row. China is the one that's causing all the anxiety and heartburn in the marketplace right now. So as of the reports that we've received to date, China as a country has not officially purchased any U.S. soybeans. Now, I do want to comment that sometimes there will be a sale, and it's called an unknown destination. Well, that unknown destination is basically a U.S. company selling it to another global trading company, and that global trading company has not released or not may not even know where they're going to resell it. And some of those unknown destinations do end up those shipments do end up going into the Chinese market. So we may have there may have been some sales with expectation to deliver into China, but they have not been officially recorded. So the mentality of the psychology of this is that, so far China has not bought any US soybeans, and we usually see some pretty good advanced export sales by China at this stage. And this is what's causing a lot of concern and anxiety about, are we actually going to get soybean sales to China? And if so, how much volume are we looking at? The one thing I want to, and this is looking at kind of the same thing in a little bit different format. So this is weekly export sales. How many new contracts do we see for the sale of and future delivery of U.S. soybeans by week? So let me go back. This one is the total that we have from so far this year. So this is as of, again, the information we received this morning. Now, this is a graphic of how many new sales did we get last week. So you can see from the red line, which is our current marketing year of 25-26, that's new crop, that we have had some sales. This week was better than last week for our sales of U.S. soybeans. The majority of those new sales that occurred over the last week went to the European Union, Bangladesh, and Spain. Now, the challenge we have though is, so how quickly are we going to add to this pile of export sales? And that's why I put the other line graphs on there with the other colors. This dark blue, this bright blue, that's last year's numbers. So I just want to caution everybody. It looks as though we're ahead of pace from last year, but what it really means is no, we're not, because we haven't had a lot of new sales hitting the books over the last couple months. And so our total sales are below normal, even though last week we got some additional sales. So the reason I'm throwing this up is it's a timing issue. The timing of our ability to sell soybeans is very, very critical. If you notice, starting at about mid-October, when the combines start running, we start to get a lot of purchasing from the U.S. for our soybeans right off the combine. And those peak in export sales, our ability to sell into the global market, extends probably into this January time period. So think about this as kind of the Christmas season for selling U.S. soybeans. And my challenge is, and our concern is, well, if we miss the Christmas sales season, what happens to all of our inventory? What happens to all of the soybeans we have and we have in produced if we miss the Christmas holidays? If we miss this export window and our ability to sell into the global market, what do we do? And that's the big concern in the marketplace right now. And that's why you're starting to see these the soybean basis levels at the local market starting to really drop very, very quickly. Because even though the futures market is anticipating we're going to have a pretty good export season, the cash market is saying, yeah, but we haven't seen any sales so far. So if the local elevator buys soybeans today, they are not really sure who or how much they can resell into the export market and be able to make delivery. Okay. So let's talk about first an update on where we are with the trade negotiations with China. So there has been an additional 90-day extension of the reciprocal tariffs to allow more discussions and negotiations to try and get some kind of tentative agreement when it comes to this trade update between the United States and China. My concern and challenge is that 90-day extension runs until November 10th. Now, this is my expectation, and it's probably the expectation of a lot of traders, is that, you know what, we probably won't get a lot of movement in our trade deal until we get right up next to that wire, right up next to that November 10 deadline. So let me go back one. Well, if we wait until November 10th, which would be about in this peak season right here, before we have an official trade agreement with China, how many soybeans are we actually going to be able to sell to China? Recognizing that, let me go back one more. China is our number one soybean customer. Okay, so we do need, if we're going to have good export sales, we're going to be able to push this big crop through our system. We're going to need to have some export market sales to be able to help us out. And China is our largest market, and it's going to be one of those nip and tuck things. There's the market is very worried. Are we going to have enough time in our export season to be able to sell all the beans that we need to? So an update, President Trump and President Xi are going to talk by phone tomorrow. They're not going to get in person, but they are going to talk by phone tomorrow. You probably heard over the news that the U.S. and China did reach a framework agreement over TikTok, and I know potential sale, if you will, of the U.S. branch of TikTok. So it sounds like they got a deal. TikTok's not going away. I know there's a lot of people sweating bullets over that one, but yeah, we got an agreement on TikTok. So the talks tomorrow, the phone call tomorrow, is to make sure that there's a formal recognition and agreement between the United States and China over the terms of that sale. Now, everybody's expecting that they are also going to be talking about other issues. Now, the people in the ag markets are really excited, saying, well, are Trump and Xi going to start to talk about some of these ag issues or not? And we really don't know. We won't know until after the conversations have ended. The other thing that's adding stress to or tension with these trade discussions or trade negotiations is that the U.S. is very upset with China for buying a bunch of Russian oil. And so the President Trump and his administration is really putting a lot of pressure on China, India, and even into Europe for their willingness and the amount of oil, crude oil that they're buying from Russia. And he really wants that the sanctions, economic sanctions in Russia, are as effective as possible. So these are some confounding impacts going on with this trade discussion. So there's a lot of pressure. And my concern, I guess personally, my concern is I don't know how far up the list agriculture will be able to get, especially given a short timeline for a discussion on Friday. So I'm hopeful, but I don't anticipate to hear anything major coming out of that for agriculture specifically. So basis levels, and I know I'm running a little bit long here, but there's a lot to cover. Harvest basis levels for soybeans right now. I did a quick survey at some locations around central and eastern North Dakota. Basis levels are running anywhere from $1.30 to $1.60 under the futures. For corn, on the other hand, basis levels are minus 55 to minus 70. So we're seeing some abnormally wide or abnormally negative basis levels for soybeans, but some very typical basis levels for harvest for corn. And the main reason for that is we're having good at corn export sales, and some of those corn deliveries are going to be right off the combine. So the market is signaling right now through basis, we want you to ship your corn. We have home for corn. We have rail cars already booked. The system is set up to handle corn very, very rapidly. Let's get some of this really, really super big corn crop moved through the system and try and limit the amount of outdoor storage that we're going to have to deal, because we're going to have a tremendous, tremendous crop of corn this year nationwide. So even locally, the local market is saying, all right, make sure that we try and push the corn through the system. It doesn't mean that you have to price it. You don't have to sell it off the combine right now, but at least they're saying deliver it so it can be shipped. So there are some delayed pricing contracts that I'm going to talk about in a minute that allow you some pricing flexibility. However, the soybean basis is saying the opposite thing. They're saying, man, if you deliver soybeans at harvest, we're really going to penalize you for that, because we're concerned that if we buy them, especially the elevators or the export terminals, start to buy them, that they're not going to have a home to be able to resell those. Are they going to be able to buy them and roll them over and get them out of the country? So historically, usually at this time of year, the market is telling farmers, especially here in the Northern Plains in North Dakota, the market traditionally said get rid of the soybeans, push the soybeans through the system because we need them right now. You saw that peak demand for soybeans, and store the corn for later. This year, the exact opposite is happening. The marketplace is saying, no, we don't need your soybeans right now because we're not sure what we're going to be able to do with them. So store the soybeans, but move the corn through the system. And it's going to take a while for people to kind of get their mind wrapped around that. So there are some elevators that are not offering these delayed pricing contracts where you deliver the corn, you officially or corn or soybeans, you officially sell it so the title is transferred, but you don't lock in the price until sometime later. So it allows the grain to be delivered and to be moved through the system legally, and then you as the farmer have the flexibility from a pricing standpoint to be able to lock in a price at a future date. Now, some elevators, actually quite a few of them, have said, we're not offering those kinds of contracts for soybeans. We're still buying cash soybeans. So if you want to sell soybeans at harvest, sell it right off the combine. If it comes across the scale and you unload it, it's going to be sold and you get whatever the price is for that day that you deliver. They're not going to offer this pricing flexibility for soybeans because the elevators are not really sure how long it will take to be able to move these beans. So they're really struggling with how do we do this. So to be very, very clear, most of the all of the elevators that I have talked to and most of the elevators that I know of will be buying soybeans and soybeans off the combine, but they're not going to offer this delayed pricing contract flexibility. But they are offering that flexibility for corn and wheat. Okay, so if we're trying to get some bin space, you're trying to get some room for the soybean crop to be able to store it, the market is actually incentivizing you to push the corn through the system now and make room for the beans. So the moral of the story, this is what the market is telling you is store soybeans, move the corn. Okay, and I want to make sure everybody understands that. Now, so the issue is let's find a home for the soybeans. We'll worry about trying to price it later and worry about the marketing plan. Let's get through the harvest season and make sure we find a home for everything. So with that and my very, very long explanation, I will stop sharing and I will kick things off to Tim Petry. Thank you for your patience.
Good afternoon, everybody. Tim Petry, Extension Livestock Marketing Specialist. Going to quickly, like I usually do, go through the cattle and then throw in some of the competing meats or livestock as well. So again, it's kind of a broken record, and so I guess I can move through this quite fast. But we continue to set records on fed cattle prices. Now they have backed off the last couple of weeks. All-time record high of 244 back there a couple weeks ago and at 240. So, very strong prices. They are going down and, some people are worried about this. And however, that's a typical thing for this time of the year. And when I'm going to look at the cutout value. And of course, fed cattle prices follow the cutout value. So I'll talk more about why that is. And one thing that I just did want to mention, and again, this probably isn't, in some respects, it's a typical year because they went up at least into mid-year and now backing off a little bit now before that Labor Day's over and Thanksgiving is coming up and so on. But looking at the rest of the year, the two red there are the futures market. October futures closed the day at 232.37. But anyway, the market does tend to go up then after the Thanksgiving is over, and then the buying for the holiday season starts. In 2023, the green line it went up, and 2022 it went up. 2023 it didn't really do much till kind of the end there. But I looked just back at the odds of what the yearly high is, and so far our high was just back there a couple of weeks ago, and in August, towards the end of August, and there's actually a 2% chance of August. If you're a Las Vegas bettor, there's only a 2% chance of August being the high, a 0 chance of September being the high, a 2% for October, and 11% in November, but a 20% chance that December will be the yearly high, given that we're this far in it. So if you're playing the odds, it would mean that there'll be higher prices in December. But again, a lot of things are going to affect that, and the cutout is is going down now. So I just kind of want to move to that next, because the cutout, if you'll see here, look at fed cattle, how much higher than they were than last year, and kind of that seasonal movement. It just parallels the cutout value, which is packers can sell meat for. And so again, that backed off last week. And this, in the past week, now it's really been falling off there. And so, that's got the traders in the futures market all jittery. And so, we'll kind of have to see what happens. If you go down then till in the past week, well, down below a week ago, on Wednesday, then the September 9th, we were at 405.64, and then every day it's just been down, down, down. And as of yesterday, the cutout was down to 388, which is down 17.46. And then not on my chart is now that the morning just came out, and it's down another $1.73, down to just a little over a $19 decline. And but again, when you look on a seasonal basis, Labor Day is over, and so the market historically does go down. And Thanksgiving is coming up, and more on that in a minute. As you know, more of a turkey thing. But after Thanksgiving, then the market does usually pick up. The cutout does pick up for the holiday, prime rib and so on, holiday season there. So that is likely to happen again. I know the traders now every day are looking at that cutout value, and the sky is falling and people quit eating beef and so on. But just want to caution you again that that's kind of a seasonal thing. And again, if you want to play the odds, that then we would pick back up. So then here's the futures market, and so you see the futures market too has been going down the last couple of weeks, looking at that cutout value. Actually, I pulled this off about 11 o'clock, and then the futures did spike up. So again, they did close up there at 232.37. So they're back up a little higher. But again, the futures market is really jittery there, not only because we were at all-time record contract highs, which causes it to be jitter. So then anything that might come along really, really affects the market. So we can go back there, for instance, to last Tuesday, a week ago Tuesday, the market crashed there over $5. And the main reason for that was that morning, Trump was being interviewed, and they asked him about high beef prices, and he said, well, I brought down egg prices, I brought down gas prices, and now I'm going to bring down beef prices. And so wham, the traders, that's the market around the feeder cattle futures actually went down the limit of 925 that day because of that announcement. But then they, kind of funneled back up. Then again, last Friday, if you go 4 more over there, kind of in the middle, then we had another, that went up to begin that day, and then it crashed. And there was just another thing. The media found out that Secretary of Ag Brooke Collins was flying to Texas to make an announcement. And the more on that when I talk about feeder cattle, but the Mexican border is closed to feeder cattle. So then there was a rumor she's going to Texas. The Texas Cattle Feeders Association is a big, well-to-do lobbying group of big Texas feedlots, and they want the Mexican border open because they're, way under capacity of cattle on feed in Texas because they're not getting the 20,000 head of Mexican feeder cattle in, so they've been lobbying hard to get the border open. So the rumor was she's going down there to appease the Texas cattle feeders, and she's going to open up the border so the market crashes again. And in reality, she's from Texas. That's her home. So she was going home. Yes, she did make a speech, but that was basically so. Then on Monday, she didn't make the announcement. So then they pop up. So that's the world we're living in. Highly volatile futures market, and any little thing that comes along, it causes the market to be volatile. So another thing that I haven't been talking about lately and just kind of wanted to update you is the other, you might say, substitute meats or competing meats that we have and how they're doing. There's kind of a, President Kennedy used a phrase a lot back when he was president that a rising tide lifts all boats. He was, referring to the overall economy, and that's something that's good for one part that happens, kind of the trickle down effect there, but it's also can be used for the substitute or the competing products of how that goes. Economic theory says if the price for one product, let's just use beef, is high, that would increase the demand for the other substitute products or competing products, because of the substitution effect there, and people would substitute the high priced beef with other commodities like chicken or turkey or so on. But also economists say ceteris paribus, which is a Latin term meaning all other things equal, and all things are not equal when we talk about this. But in general, all the other livestock prices are have came along kind of with beef, not to the same degree, but are higher too. But again, not only demand affects prices, but also supply is a big factor. So that comes into play there. So just quickly go across from the top left. Base slaughter hog prices, carcass prices, they're very seasonal. They go up into the mid-year when pork production is low and demand for particularly bacon in their cutout is very high because of the home tomato season and so on. And then it backs off into fall. But, above last year and above the 2019 to 23 average. So hog producers are making money. Go across to lamb prices that I've been showing you in the last few webinars. Again, they're high in the spring, but tend to fall off some in the fall, and they haven't fallen off a lot yet and are hanging in there with good demand and some shorter supplies of domestic lamb, although we are still importing a lot of lamb. Go down in the bottom left then to chicken. Again, chicken prices have been higher than they were the average and higher than last year. They fell below that now. We produce a lot of chicken, and we've been producing records amount of chicken, and chicken, the USDA's forecast for chicken production again is for it to be higher this year at record high levels. And so putting a lot of eggs into the incubators and so on. So that's brought the chicken price down a little bit below where it was last year, but looking throughout the years remained up there near last year. And then going over to turkey, again, we have a supply issue there, the opposite of chicken, and that avian influenza is hitting the turkey industry again. We've had 2 commercial turkey places in North Dakota and 1 in South Dakota, and just announced today in Minnesota another one. So that's affecting the supply. And then the demand for turkey obviously now is up there at high levels, getting ready for the Thanksgiving season. So they are also at higher levels there. So let's get into calf prices again. Just been a fantastic year for all cattle prices, particularly since April, just going up at unprecedented levels and historically high or record high. And so, but usually then last year calf prices on the blue line did go start their seasonal decline earlier because it was so dry in the southern plains was a big thing there. And they started selling calves early. And I didn't bring the drought monitor map, but it was very, very dry down there, and the winter wheat was planted in dust and wasn't coming up. And there's a demand for calves to put on winter wheat when they do have it. So there was no demand there and being marketed. So that caused the market to go down, although it did start raining down there. And always then when the Corn Belt cattle feeders come into the market after the Corn Belt harvest is over with, they tend to spark the market some too. And so the harvest last year, the corn harvest got done in record time. And then it started raining down in the southern plains, and they did end up having some winter wheat. So that helped spark the market. So this year, we've got a short supply, the shortest supply of calves we've had for many years. And, fed cattle prices affect them. And so, if fed cattle prices continue to hold, and, Frayne talked about corn prices are low with, like he said, the all-time record crop. And we do have, at least as of now, excellent prospects for winter wheat because pretty much all of Texas, Oklahoma, and Kansas winter wheat area is in good shape with little drought. And so that would support the price, but they're still going to go down on a front looking at supplies. Still likely to go down seasonally, I think, supported down there at least around 390. And the other thing is like I always mention on calves, we talk about one price here, but at the auction markets, when the runs start hitting here, there's a $30 to $40 range for the same weight and grade of these 550 to 6 weight calves at the same market for all the different market factors that affect them. So yeah, there's probably going to be $470 550 weight calves selling, but also $370 or something for all the factors that affect them. So this is kind of a middle price. So we do expect them to fall like they usually do seasonally, but still maintain probably at record high levels there with the lower supply and the good demand for winter wheat. And the Mexican border is closed. So we're getting 20,000 less Mexican cattle in here every week as well. So just to move along here then, the heavier weight feeder cattle about the same then, and they've just been up and very strong demand at the feedlot sector. There's the futures market, the red squares over there, and that doesn't mean that our cash price is going to be that low, although again they usually do peak out here in September and go down every year, you see from the other years, and so I do expect them to go down, but we're running like a $10 positive basis now from the futures or cash settlement price. But I think they're as well, along with calves and all the supply in the market, and now they're going to see some seasonal weakness, but still supported down there. But but at least where the futures market is. And just to kind of wrap up, there is a cattle and feed report out tomorrow. The main thing I want to mention there, that a new thing starting in July, that USDA does not offer livestock risk protection the day the cattle and feed report comes out, because the market comes out at 2 o'clock Central Time and the futures close at 1 o'clock. And so then LRP isn't offered till about 3 o'clock after the report comes out. So there was some concern by USDA that you can't do futures or anything else. And if the report is negative, that you could still get LRP. So simply it isn't offered. But the expectation of the trader up there on the upper left-hand corner, expecting to be for cattle on feed to be down almost 1%, which, we've got fewer cattle and so on, and placements to be down about a 9% there. And another thing we got going on, it shows cattle marketed at about, down 12.9% or something. But we had one less market day this year than last year, so that also funnels into placements and to market. So we had one less day. But over on the right hand side, then, if the trade estimates are correct, this is the time, August is usually the low, and then we pick up in September because all the yearlings, are starting to come to market and so on earlier by August and so on, and then go up. We would be up to about 11.1 million head, which would still be low average in the last year, but in tune with the lower supply we have. But again, like Frayne mentions on the market, it's, we know that cattle on feed is going to be down, but what might affect the futures market on Monday would be is if the on feed numbers would be kind of higher than we expected. So with that, I will stop sharing and turn it over to Dave.
Yeah, so I just have a few comments to make today. One related a bit to, skipped a line, related to WASDE. So we see within the corn S&Ds, the projected use of corn going into ethanol. And one of the questions you get is, how much more could ethanol contribute? And from a production capacity standpoint, there's actually, about 3 billion gallons of excess capacity, which is about 1 billion bushels of corn that could be used. The bigger issue is where exactly is that going to go, which leads to this next slide. If we look at what's happened with gasoline use in the United States, we had obviously this big disruption during COVID, a significant drop. And since then, we have not fully recovered to previous levels, to those pre-COVID levels. Again, driven by a couple of reasons, EV adoption to some extent, fuel economy to some extent, changes in travel behavior to some extent. And so growth of ethanol in transportation, in large part, is really moving from it being used as a fuel additive at that 10% blend rate to a higher blend, for example, E15. And of course, within the industry, we have the capacity to do that. We have excess capacity, but building a market like that, and we've actually seen relatively steady growth in E15. It's not like flipping a switch. And so the estimates that the World Ag Outlook Board has at 5.6 billion bushels is high. I think it's actually quite realistic. And again, there's physically it'd be possible to produce more, but really putting in the market doesn't quite work. Part of that is actually the result of the relative price of gasoline and ethanol. Gasoline right now is not particularly expensive. And so to really price ethanol in on an energy equivalent basis, price would have to fall even more. What I show here is ethanol margins for a South Dakota refinery. This is from USDA. They report numbers every week for ethanol prices for a number of states, not North Dakota. We don't have quite as many ethanol refineries that would really allow the averaging of the data to hide who might be sitting where. But really what we're looking at, like moving from those individual prices to the lower right-hand corner, so that gross margin of about $1, that's a really nice profit, covering capital expenses, covering operating, that gets you to what I call essentially normal profits, normal returns, to really drive down ethanol price. We'd have to see an even larger fall in corn prices. And you can see there you're looking at 370 corn. Again, that would be cash corn in South Dakota last week. It really doesn't have that much to give in order to drop ethanol prices another 10, 20, 30 cents, which is what would be needed to get it into the fuel blend. Just something I wanted to talk about. Another thing that is brought up, and there's a lot of activity, but it doesn't always make the top of the front page for the Ag Press, is what's happening in carbon, especially with respect to agriculture. There's been a few news stories. In our area, just a couple of weeks ago, Land O'Lakes announced that they are essentially winding down Truterra, really limiting the amount of activity that they have there. A couple of stated reasons: yes, federal sustainability, but also just the general appetite for carbon offsets is weaker than it was even a year ago. At the same time, there are other stories, and these I don't think made the egg press here in the Midwest for the most part. There are carbon deals being signed, and so bring to point a specific one with Microsoft and a company called Agoro Carbon, which you've probably never heard of before, but you've probably heard of Yara. So Yara is a large fertilizer company based out of Norway. This is really interesting for a couple of reasons. One, Microsoft has been one of the bigger consistent players in carbon. This is a relatively large transaction, even over that 12-year horizon. But it's also of note too, when we think about Yara, because they are European based, they're a global company like many agribusinesses are. But their executives wake up, live, and fall asleep in Norway, in Europe, where the perspectives on climate and greenhouse gas are different than they are here. And so while we've seen a change in priorities here in the United States, biggest example being the change in administration and the change of priorities that they've made, the actions that they've made, there are still others, both in the United States and especially outside of the United States, who are very, very active in this space. And again, the other point with Yara being a fertilizer company, there are opportunities, and this is both for producers as well as for agribusinesses, of marketing products with a smaller carbon footprint, or that might reduce emissions or allow the capture and storage of CO2 or of carbon in the soil. So just something I wanted to highlight really quick. One, ethanol is contributing. It's a great home for corn. Two, it has the ability to physically do more. The market is not there. Building out E15 in the short run is really not a possibility. And finally, there is activity in carbon, and this is in addition to some of the more prominent farmer-facing activities. I'm really interested to see what's going to happen going into 26 with farm signups. Again, a lot of that activity is going to start taking place after harvest. How aggressive are some of these companies going to be to get acres signed up for carbon programs in 2026? And there will be some, because the federal government, even after Climate Smart Ag Commodity Partnership was retooled, the money was still there. They just wanted to make sure that the money got to the farmers. And so there's still a few $1 billion that are going to be spent for those programs that were either retooled or met these qualifications that the administration put in place. That ends my prepared remarks. We'll be meeting again in about a month, October 9th. I'm going to warn Frayne, if he doesn't know already, this is a quick turnaround because the WASDE will be released at 11 a.m. On the 9th. But with that, I'm really happy to facilitate any questions. And Frayne, I think you may have seen the one regarding durum prices.
Yep. Yes, I did. I looked up some information while you were visiting. So real quick comments on durum. We did get a StatCan, Statistics Canada did increase or release their forecast for production. There was an increase from not only from last year, but even from the last August report in durum, the expected durum production, mainly in yields. Now, just a caution, in Canada, because of some budget constraints, they do not do farmer surveys, nor do they go out to do objective yield surveys. So they're using satellite imagery, they're using computer modeling based off of the crop health to try and forecast and estimate what yield and yield potential is going to be. So the numbers did go up. They were at about 6.1 million metric ton in August. They're now projected to be 6.5. So there was an increase in the durum production numbers. Again, I want to be a little cautious because those are satellite imagery based information, not actually ground truth from a objective yield survey. The other thing we've seen in prices is that the spot market price for durum really hasn't changed that much over the last several weeks, last probably 3 to 4 weeks. But we've seen the deferred months. So if you deliver today versus store, that those deferred months, they were at a higher price and they have now dropped. So there's really no carry in the marketplace. So at this point, what that's signaling to me is that given the expectations for a higher durum output in Canada, we don't know what the quality is. Admittedly, we don't know what the quality is, but given the expectation for a higher output, that the durum millers or the durum demand base may not be as strong moving forward because they're anticipating that we're going to have good supplies going into the early part of next year. So just a quick update on durum. I'd be happy to try and talk with people offline if they have more additional questions.
Thanks, Frayne. I actually have a question for you. So I was in Omaha yesterday talking to some bankers after our good friend Chad Hart gave his crop outlook. And he got a question from the audience regarding USDA's WASDE report and looking at how the statement was made by the banker. You know, why is it that each year, why does USDA have these numbers that depress prices? And then, you know, you have these forecasts of relatively large ending stocks, and then you get through the year or you work through the year and the stocks aren't going to be as large and the price rises. Why does USDA do
that? Well, I can assure you they don't do it on purpose. This isn't something where they're systematically trying to influence prices, because I'm sure that's where the thought came from. The simple answer is that early on in the season, when you think about, again, forecasting both supply and demand for the crop that we haven't harvested yet, at this stage of the game, there's a lot of forecasts, a lot of estimates. And as we move through time, as we move forward in time, we get closer and closer to the end of the marketing year in September, we get more and more real information. We get more harvest reports. We get more export sales numbers. We get a better read on what the domestic consumption is going to be, whether it be for ethanol or for soybean crush or for wheat milling. So as we move through the year, we gain accuracy, and it becomes more and more reliable in estimate. And over the last couple of years, what we've seen is, I guess from my standpoint, two things. There has been maybe early on an overestimation of what the yields are going to be, and by the time the combines finally ran, we found out there weren't quite as many bushels as we expected. And then the other thing is very difficult, very complex to try and forecast or estimate what export sales are going to be. And you can have really big margins for error in the exports number, even at this stage of the game. So what we've seen is, as we go through time, that those export numbers have been a little bit better or more aggressive than we had expected. So the combination of those two can make the bottom line jump around pretty quickly. But I can assure you that there's no conspiracy out there to try and manipulate prices or get prices at certain levels at certain points in time. It's all a matter of just differences in estimation and the ability to be able to forecast the future.
Thanks, Frayne. Your answer was like the same as Chad's, but yours was a little bit better. So just in case you're wondering.
Just pass that on to Chad, would you?
I'll let him know. I'll let him know. With that, not having any more questions, I want to thank all the presenters today and everyone who was able to join us in real time, and the folks who asked questions, which I guess includes myself. We'll see you again in just a few weeks on October 9th. And again, we'll share with you this video in just a few days so you can access it. Thank you.